the backdoor Roth IRA. This video is going to show you how to get around the IRS's income limits if you make too much money to contribute to a traditional Roth IRA. Hi, I'm Troy Sharpe, CEO of Oak Harvest Financial Group, certified financial planner professional, and host of the Retirement Income Show. The IRS puts income limits on the ability to contribute to a Roth IRA. If you haven't seen my video about the Roth IRA, please click on the little I right here, watch that video first, get a primer, and then come back to this video. But the backdoor Roth IRA is for as long as we can do it, and we can still do it now. I don't believe this will stay in effect forever. But we can get this done now if you make too much money to contribute to a normal Roth IRA. So if your income limits, if your income, modified adjusted gross income, is above $206,000 and you are married, you are disqualified from contributing to a Roth IRA. If you're a single filer and your modified adjusted gross income is above $139,000, you also are disqualified from contributing to a Roth IRA. But don't fear. We can still contribute to a Roth IRA through what is known as a backdoor contribution. So to clarify, Roth IRAs are individual accounts. You can still contribute to your employer-sponsored plan. So if you have a 401k and it has a Roth option inside that account, or a 403b that has a Roth option inside there, you can still contribute, and I would recommend contributing money there. Again, watch my previous video to learn the differences between traditional 401k IRAs and tax-free Roth 401k and IRAs. So if we're above these limits, we cannot contribute to the individual Roth IRA. But what we can do is open up a traditional IRA. We open up a traditional IRA instead of a Roth IRA. We make a contribution to this account, this IRA account here, and we are not going to be able to take a tax deduction. This will be considered a non-deductible contribution to an IRA. Normally, if you make under certain income limits and you put money inside an IRA, you get to reduce the amount of your taxable income by the amount of the contribution that you've made. That's called a tax deduction for making a contribution to an IRA. There are no income limits to opening and contributing to an IRA, though. You just lose the ability to deduct that contribution. So this is the backdoor Roth. What we're going to do here, we're going to open up a normal IRA. If you're under the age of 50 in 2020, you can contribute as much as $6,000 into this. Again, no tax deduction. And then you immediately convert this IRA to a Roth. And now your $6,000 non-deductible contribution that went into the IRA, you put it in there, no tax deduction, convert it to a Roth, and now your money is inside the Roth even if you have income above the limits that the IRS says you cannot make more than in order to have a contribution into a Roth IRA. So this is what the backdoor Roth is called. Now, there is a very, very important caveat here. It is called the Prorata Rule. Long story short, if you have a bunch of money already in IRAs, this is probably not going to be a viable strategy for you. So let's say you have an existing IRA account that has $500,000 in it. What the IRS says is if we make a non-deductible contribution into an IRA and then we convert that to a Roth IRA, we have to calculate what the proportionate tax conversion is. So what that means is if you put $5,000 into another IRA, non-deductible contribution, and then you want to convert that to a Roth, well, you have to take into consideration this other huge IRA that you have, and they're going to make you pay taxes on a portion of that. So you can't just single out this $5,000 non-deductible contribution that you made into the IRA to convert to a Roth. Normally, if you don't have any other IRAs, this is 100% tax-free conversion because it's a non-deductible contribution. But the Prorata Rule says if we have other IRA balances, we have to take into consideration the amount in those accounts, and when calculating the tax due for converting this to the Roth, as we would in the normal backdoor strategy, we have to pay taxes on a portion, proportionate, a pro rata amount of the existing IRA dollars. It only pertains to IRAs that you have. So if you have 401ks or 403bs, those are employer-sponsored plans. Those are not included in the Prorata Rule, just any other IRAs. One way to get around this, you could consider rolling your IRA into the 401k at work so you no longer have an IRA, and then you're eligible to do the backdoor Roth contribution again. So there are some workarounds here. If you make more money than the IRS says you can in order to contribute to a Roth IRA, the backdoor may be an option to consider, but be very, very careful of the Prorata Rule. If you have other IRA dollars with big amounts inside there, it may not make sense for you to do it. And of course, talk to a financial professional, talk to a tax attorney, a CPA, if you're considering doing something like this and there's some fogginess around your understanding of the rules. If you like this video, please share it with a friend or a family member. Our whole goal and mission with this channel is to help you get more connected to your money and help as many people as we can get more connected to their money. Make sure to hit the thumbs up button that likes the channel. Also hit the subscribe button and then that little bell icon right next to it. When you click that, that's going to notify whenever we upload new content so we can keep you more connected to your money and you can make better decisions for planning for your future.